Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we're going to look at Deloitte acquiring a cannabis compliance company, as well as asking what's the difference between speculation and investing. And for those that don't know, Deloitte is a huge company. They're one of the top 4 tax companies. They're big in consulting, mergers and acquisitions. They have risk and financial advisory, audits, all of that. Numerous industries and insights. And so it's kind of a big deal to have somebody of this caliber jumping into cannabis to try and weed some of these companies out to give solid information. So kind of a big deal, but not getting a lot of exposure, but essentially being able to provide end-to-end services covering a complete cannabis consulting spectrum. And so with the year 2020 being a lot about the bottom line, less about speculation, more about generating revenue and profitability, we're going to ask that simple question is, what's the difference between speculating and investing? Or in other words, are you an investor or are you a speculator? So in today's market, the majority of investors are simply chasing performance. But why would you not expect this to be the case when financial advisors and the mainstream media, Wall Street, they're continually to press the idea that investors must beat some random benchmark index from one year to the next? Investing ultimately is about managing the risk that you substantially reduce your ability to stay in the game long enough to win. An author who wrote The Art of Speculation in 1930 believed motive was the test for determining the difference between investment and speculation. The author connected the investor to the economics of the business and the speculator to price. And speculation, he wrote, may be defined as the purchase or sales of a security or commodity in expectation of profiting by fluctuations in their prices. And so chasing markets is the purest form of speculation. It's simply a bet on the pricing to go higher rather than determining if the price being paid for those assets are selling at a discount to fair value. So while the meaning of investment has been lost on a lot of individuals, there's the following 10 guidelines from legendary investors that'll hopefully get you back on track. So Jeffrey Gundlach of Double Line said that the trick is to take risk and be paid for taking those risks, but to take a diversified baskets of risks in a portfolio. So there's a common theme that you'll see throughout this post. Great investors focus on risk management because risk isn't a function of how much money you'll make, but how much you'll lose when you're wrong. So investing or gambling, you can only play as long as you have capital. If you lose too much capital by taking excessive risks, you can no longer play the game. So be greedy when others are fearful and fearful when others are greedy. One of the best times to invest when uncertainty is the greatest and fear is the highest. Ray Dalio of Bridgewater Associates said the biggest mistake investors make is to believe what happened in the recent past is likely to persist. They assume that something that was good investment in most recent past is still a good investment. Typically, high past returns simply imply that an asset has become more expensive and is poor, not better investment. Nothing's good, bad, or goes on forever. The mistakes that investors repeatedly make is thinking that this time is different. Seth Klarman of Baupost said that most investors are primarily oriented towards return, how much can they make, and pay little attention to risk, how much can they lose. Jeremy Grantham of GMO said you don't get rewarded for taking risks, you get rewarded for buying cheap assets. And if the assets you bought got pushed up in price simply because they were risky, then you're not going to be rewarded for taking a risk, you're going to be punished for it. Successful investors avoid risk at all costs, even if it means underperforming in the short term. Jesse Livermore of Speculator said that speculators' deadly enemies are ignorance, greed, fear, and hope. Allowing emotions to rule your investment strategy is and always has been a recipe for disaster. Number 6 is Howard Marks, Oak Tree Capital Management, who said rule number 1 is most things will prove to be cyclical. And rule 2 is some of the greatest opportunities for gains and loss come when other people forget rule 1. James Montier of GMO said there's a simple, although not easy alternative to forecasting. Buy when an asset is cheap, sell an asset when it gets expensive. Valuation is the primary determinant of long-term returns, the closest thing we have to a law of gravity in finance. Cheap is when assets selling for less than its intrinsic value. George Soros of Soros Capital Management said it's not whether you're right or wrong that's important, is how much money you make when you're right and how much you lose when you're wrong. Jason Zweig of Wall Street Journal said regression is the mean, it's the most powerful law of financial physics. Periods of above average returns are inevitably followed by below average returns, and bad times inevitably set the stage for surprisingly good performance. Howard Marks of Oak Tree Capital Management said that the biggest investing errors come from not factors that are informational or analytical, but from those that are psychological. Benjamin Graham said that investors' chief problem and even the worst enemy is likely to be himself, which is why we have an AI-based technical analysis. So our smart trading robot doesn't care about all of that, just looking at the technicals, not the emotions behind it. And that's why we're up 20% when the next closest competitor is down 5% in the last 90 days. So if you remember this last point, if you run out of chips, you're out of the game. Which is kind of why it's important that Deloitte is acquiring a cannabis compliance company. Again, this is kind of big news because you're getting one of the biggest accounting firms, one of the higher reputable firms out there is getting behind the game. And so I think that's a big indicator, a huge smoke screen to say that this is going to move forward. And it's going to be even better with reports from Headset and with consulting and auditing and tax advice from Deloitte. These are just things that are normalizing. Headset is working with Nielsen. And so aggregating all of that data and getting some really good advice is really just kind of showcasing how the industry is normalizing and professionalizing and moving forward, but looking for obviously revenue, right? So if it's not in profitability, speculation is out the window for 2020 and beyond. So with that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. By the way, if you enjoy the content, please show your support with the cushy gesture of $4.20 a month on the Talking Hedges Patreon page. This will kind of help me spread the word. I've been asked to speak all over the world, from Toronto and Colombia, Spain, Miami, all over, Tokyo. But your support's important to me. I haven't monetized the podcast. I want to be as authentic and transparent as possible. I want to avoid conflicts of interest or even the perception of paid opinions. So don't forget to like, share, and subscribe, or pay me on the Talking Hedges Patreon page, or don't, and I'm out.